What are government securities? How does the government raise money through them? One morning, a man was reading the newspaper. The news stated that foreign investors have received tax relief on Indian government bonds, and suddenly, 𝐻𝐸𝐥𝐸 came into discussion again. That man thought, if the government needs money, it must be raising taxes. Then what on earth is this story about bonds, securities and auctions? The fear starts right here, because the common man thinks that government borrowing means an increasing debt on the country. But the truth is a bit deeper than that. And the curiosity is, how does the government raise lakhs of crores of rupees without going door to door? Who gives money to the government, and what do they get in return? Government securities, which are called 𝐻𝐸𝐥𝐸 in short, are debt instruments issued by the government. In simple terms, it is the government's official way of borrowing. When an investor buys a 𝐻𝐸𝐥𝐸, they lend money to the government. In return, the government promises to pay interest at a fixed time and return the principal upon maturity. Understand it like this, as if a reliable person borrows money from you and gives a written promise stating when they will pay interest and when they will return the entire amount. The only difference is that here the borrower is not a private individual, but rather the government of India or a state government. Therefore, the default risk is practically considered very low. According to the RBI, a 𝐻𝐸𝐥𝐸 is a tradable instrument. Meaning, it is not necessary to just buy it and hold it until maturity, but it can also be sold in the secondary market. Why does the government need money? Because running a country is not limited just to salaries and offices. A large expenditure is incurred on roads, railways, defense, subsidies, welfare schemes and infrastructure. Many times, government revenue, meaning tax and non-tax income, falls short of the total expenditure. This gap is called the fiscal deficit. To finance the fiscal deficit, the government does borrowing. The government securities market is the large and organized method of this very borrowing. If the government raises taxes to fulfill every shortfall, then the burden will immediately increase on citizens and businesses. Therefore, borrowing becomes a planned financing tool. This borrowing does not happen in a hidden manner. It happens in a structured way, through the government borrowing calendar, RBI auctions, and market mechanisms. The RBI acts like the government's debt manager in this process. It conducts auctions and handles the issuance of securities, interest payments, and the repayment process. 𝐻𝐸𝐥𝐸 can mainly be understood in two broad categories. First are short-term securities, which are called Treasury bills or T-bills. Second are long-term securities, which are called government bonds or dated securities. The government uses their money for a long period. Treasury bills are for 91 days, 182 days, and 364 days. These are zero-coupon securities, meaning regular interest payments are not received on them. A T-bill is issued at a discount and the face value is received upon maturity. Suppose you got a 100 trillion rupees bill for 98 rupees, then the difference becomes your return. Dated 𝐻𝐸𝐥𝐸s work in a different way. Their maturity can be of many years and the investor generally receives half-yearly coupon interest. The names of these securities are also interesting. For example, 7% GS 2028 means the coupon rate is 7% and the maturity year is 2028. Coupon means that annual interest rate which is paid on the face value. This interest is usually paid twice a year. State governments also raise money. Their bonds are called State Development Loans, meaning SDLs. These fulfill the borrowing requirements of state governments. The central government issues both T-bills and bonds, but state governments generally issue dated securities or SDLs. Now the question arises, how does the government sell these securities? The answer to this is an auction, meaning bidding. The RBI conducts 𝐻𝐸𝐥𝐸 auctions on the 𝐸-Kuber electronic platform. Large banks, primary dealers, insurance companies, provident funds and institutions participate in this. In the auction, investors state at what yield or price they want to buy the security. Based on successful bids, the borrowing cost is determined. Large informed investors do competitive bidding. They quote a specific yield or price and place bids according to market conditions. For retail investors, there is a non-competitive bidding route. In this, the common investor does not have to quote a complicated yield. In the auction, a retail investor can get an allotment at the weighted average price or yield derived from the successful competitive bids. This facility was created so that the 𝐻𝐸𝐥𝐸 market does not remain limited only to large institutions, and common people can also become a part of the government borrowing system. Earlier, 𝐻𝐸𝐥𝐸 investment was mostly limited to institutions. But after the RBI Retail Direct platform, individual investors can also buy government securities directly. In Retail Direct, an investor can open an RDG account and bid in primary auctions and can also buy and sell securities in the secondary market. Apart from this, indirect exposure to G-Secs can also be taken through mutual funds, gilt funds, target maturity funds, and bond funds. Now understand the latest news of June 2026. The government has given tax relief on G-Secs for foreign investors, meaning FPIs and FIIs. According to the PIB, an exemption has been given on interest income and capital gains received by FPIs and FIIs from G-Secs. This exemption applies to income arising on or after the 1st of April 2026. Its purpose is to make the Indian government bond market more attractive for global investors. When foreign investors buy Indian G-Secs, foreign capital comes into the country. This can deepen the bond market and can also provide support to the rupee. India's bonds have started being included in global bond indices. This gives foreign funds a reason to increase allocation in the Indian debt market. But the RBI still wants to keep the settlement within the domestic system. According to Reuters, the RBI prefers direct participation on NDSOM instead of offshore platforms like Euroclear. NDSOM is the RBI's electronic order matching system, where secondary market trading of government securities takes place. The RBI's concern might be that if liquidity gets divided across different platforms, then price discovery could weaken. Meaning, the government wants foreign money, but it also wants to keep the market structure and control organized within the domestic framework. The G-Sec market is like the backbone of the country's financial system. Banks, insurance companies, provident funds, and mutual funds play a big role in it. G-Secs are important for banks because they have to hold government securities for regulatory requirements and liquidity management. The RBI also uses G-Secs in monetary policy. The RBI can manage liquidity through open market operations. If the RBI buys G-Secs from the market, liquidity can increase in the banking system. If it sells, liquidity can be absorbed. Therefore, a G-Sec is not just an investor product, it is a central tool for government borrowing, banking liquidity, and monetary policy. Now the question for a common investor is a G-Sec safe? In terms of default risk, it is considered very safe because the backing is from the government. But safe does not mean that there is no risk at all. If you sell before maturity, the price can move up and down according to market interest rates. If interest rates rise, the price of old, lower coupon bonds can fall. If interest rates fall, old, higher coupon bonds can become attractive and expensive. This is called interest rate risk. For an investor who holds until maturity, this fluctuation is not that dangerous. But if an investor is going to sell in between, it is important to understand bond price movements. The G-Sec market seems simple, but the pricing can be technical. T-bills can be useful for short-term parking because their maturity is short and price volatility can be comparatively low. Long-term G-Secs can give a stable coupon, but the impact of interest rate changes can be seen more on them. Inflation is also a risk. If your return is less than inflation, your real purchasing power can decrease, even if the principal remains safe. Therefore, it would be wrong to think of a G-Sec as an exact replacement for a bank FD. Both are products of the fixed income family, but their working is different. In a G-Sec, credit risk is low, but there can be market risk. In an FD, bank-specific risk and liquidity conditions work in a different way. Investors should make decisions after understanding maturity, coupon, yield, tax impact, and liquidity. One should not blindly invest just by hearing government-backed. A big advantage of G-Secs is transparency. Auctions, yields, prices, and maturity details are available in the formal market. The second advantage is that it can provide stability to a portfolio. When the equity market is volatile, then high-quality debt instruments can provide balance. But this is not investment advice. Every investor's age, income, goal, risk capacity, and liquidity need are different. If someone needs short-term emergency money, locking money in a long-term bond might not be smart. If someone needs regular income, they might have to look at coupon-paying G-Sec or bond fund options. If someone wants a simple route, the mutual fund route might seem easy, but it is necessary to understand the expense ratio and NAV fluctuation in it. The government also benefits from government securities. It gets funds in an organized way, and it helps in financing the development expenditure of the country. The investor also benefits because they get an opportunity to invest in a government-backed debt instrument. The financial system also benefits because the G-Sec yield works as a benchmark for the entire economy. The pricing of corporate bonds, loans, and many financial products is indirectly influenced by government bond yields. If the government bond yield rises, the signal of borrowing cost can spread across the entire economy. This is the very reason why the market watches the 10-year government bond yield very carefully. It is a major indicator of the economy's interest rate expectations. Now, talking about the RBI's new mis-selling rules is also necessary in this context. Customer consent, disclosure and suitability are going to be very important while selling financial products. From January 2027, the RBI's revised directions are going to bring strictness on mis-selling, dark patterns, and forced bundling. This is a different topic from GSECs, but the message is the same. Whether a financial product is a bond, insurance or a loan, it is necessary to sell it by explaining it clearly to the customer. Today, product access is increasing in the financial market. Bonds are being obtained directly through retail direct, mutual funds are being obtained through apps, and loans are being obtained through digital platforms. Increasing access is good, but access without understanding can become a risk. Therefore, financial literacy is no longer optional. Understanding GSECs is necessary because it connects the story of government finance to the common man. When you buy a government bond, you are not just making an investment. You indirectly become a part of the government borrowing system. Your money can join public finance needs like roads, infrastructure, welfare spending, or old borrowing repayment. But government borrowing also demands discipline. Too much debt can increase the interest burden on future budgets. Therefore, whether every borrowing goes into productive spending is a big question for policy. The deeper and more trusted the GSEC market is, the more orderly the government's borrowing can be. Tax relief for foreign investors is a step in this very direction, so that India's bond market becomes more competitive for global capital. But foreign money comes fast, and sometimes leaves fast too. Therefore, keeping the domestic investor base strong is also necessary. The participation of common people makes the GSEC market wider. Through this, financial savings can be channeled into a productive public debt system. But understanding is necessary before participation. One should ask how the return will be made, when is the maturity, what is the tax, and how will the exit happen. If an agent is selling a product just by calling it safe, the customer should ask for details. It should be clear in what sense it is safe, and in what sense there is a risk. This is the real story of government securities. The government asks for money, the market determines the price, the investor provides trust, and the economy runs on that trust. On one hand, it is a borrowing instrument. On the other hand, it is a bridge between financial discipline, investor confidence, and national development. Therefore, next time when you hear GSEC, T-bill or government bond, do not think of it as a boring finance word. This is the very mechanism through which the government raises money without immediately raising taxes, runs projects, and fulfills the funding needs of the economy. And this very understanding is the beginning of financial awareness. Because it is not just necessary to earn money, it is also necessary to understand how money circulates in the country and the market.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.